From market volatility, currency risk and sector rotation, we're adapting, and here's how. Markets are and have been reacting to Trump's new tariffs and broader global uncertainty. We're seeing volatility across all sectors, so we're adjusting. We're shifting from a slight growth bias to a more blended value approach with a focus on income and defensiveness. Currently, we're closely aligned to the benchmark with around 50% exposure to the US, but we'd like to reduce that to more closer to 40%, by mainly cutting back on the US small caps. We, as well as the market, are unsure as to what extent the tariffs will impact individual sectors and regions, but we're more confident that smaller companies will have a more volatile journey than other larger companies. We're keeping our S&P 500 index exposure, but wherever possible, we are considering the use of hedge share classes to help mitigate currency risk. In the UK and Europe, we're marginally increasing our exposure above the benchmark due to the outlook being less uncertain compared to the US. We're moving from Asia-centric funds to a more general emerging markets allocation. We feel it'd be more beneficial for the fund managers to have more geographical flexibility during this time of uncertainty. We're also introducing a satellite position in Japan through a core balanced fund which has scope to tilt towards value. In addition, we intend to mitigate currency risk through a hedge share class. This addition will give us exposure to domestic companies that could benefit from rising inflation and policy shifts. In the previous quarter, we had already gone some way to increase our global value and income exposure, and we intend to retain this allocation. Despite the potential volatility that can be experienced in smaller companies, we intend to continue to allocate to our global smaller companies holding, as our chosen fund focuses on quality businesses that should be able to continue to thrive under stress. We are also marginally reducing exposure to global growth funds, which are predominantly US weighted. On the defensive side, we have decided to trim our gold exposure, having benefited from its recent performance, and we are less optimistic for the potential returns in the asset class in the medium term. We are marginally reducing our bond exposure for a slight increase in cash in the short term. This is just as a means of reducing volatility, providing a steady and predictable return, and giving us some dry powder for future opportunities. As always, for all prospective managers and/or funds, we look for low-cost index options where active doesn't add value, hedge share classes for where we feel there is potential currency risk, and strong long-term track records that align with current and expected market conditions. As a reminder, this doesn't constitute financial advice, and there is always an investment risk that funds may go up as well as down. Before you make any investments, you should consult a specialist and make sure you are making the right investments for you at the right time. Markets move fast, so we try to move smarter. If you've got any questions, reach out and stay tuned for the next update.